Good afternoon, everyone. Welcome to this update for global stocks and commodities for the 11th of February. We've just had the most volatile week in a couple of years, and it follows on from the start of this upheaval the previous Friday when some economic data came out that got people worried a bit about inflation. Now, what I want to do in this particular video is to be very clear about some of the really important things that you need to do because at the moment there's a heck of a lot of noise out there. The media is going off. I know personally a lot of people that I run across who know what I do. All I want to talk about is the market crash. Well, quite frankly, the market hasn't crashed at all. We're just having a little bit of an overdue correction, and the outlook at a big picture level is as good as I've seen it, and I'll explain why I say that. So that's why the title of this week's video is Here Come the Opportunities, because I don't think we've been better placed than we are right now. I can't tell you that we've seen the lows just yet, because I just don't know at this point in time in the short term. But I do know that some terrific stocks with a great outlook are now a lot cheaper than they were a week and a half ago. So I think this is a very exciting period, and I fully expect that 2018 will be volatile, but it will offer up some terrific opportunities for those that are prepared. And some of the things that I want to go through in this video are to help you get prepared. So let's jump into it. So this is the best perspective and advice that I can give you. This is my distillation of many decades in the market. And I think really it's a time to be prepared. I've spoken to quite a few people of late, and universally the human reaction seems to be to do nothing at this stage, not even think about it, just wait and see what the market does, wait until some normality comes back, and then go from there. I can tell you that this is a time to not do that, to start getting prepared and know what you want to buy, and then wait for things to come on your circumstances. So I want to give you some more detail around that. There's the normal stock and commodity trend update, of course, and in last week's portfolio analyst, obviously we had the Friday and then the Monday and the Tuesday, fairly substantial sessions in America. So what I went through in great detail last week in Portfolio Analyst for well in excess of an hour was to what to expect, how to prepare for the next phase. So here are some thoughts that I think will be of value to you. The things that you must do: you must stop listening to the media. The media at times like this are your absolute worst enemy, because they're just in it to write us, to write a good headline, to write a good story, and a lot of the writers really don't understand financial markets. So forget the media, forget the grandstanders who want to predict what will happen. They're just trying to make a name for themselves. They just play into the normal fears that most people have. So ignore them. You will have voices in your head that are operating at a subconscious or conscious level that are responding to the way that we're conditioned. And the way that we're conditioned is that we want to be fearful when everybody else is fearful, and we want to be greedy when everybody else is greedy, because that's what feels comfortable. And I'm sure you've heard the immortal words of Warren Buffett, and that is to do just the opposite. Now, it's easy for him to say that, but it's actually quite difficult to do. But it is vital that you try and do that. So you've got to try and overcome the natural inclination that you will have, and that's to sit back and wait and do nothing, when in fact in the next couple of weeks we'll probably get some amazing opportunities. So that's what you shouldn't do. What you should do is read the charts, even more so in the short term. If you're more of a fundamental kind of investor or trader, then in the very short term, those fundamentals mean almost nothing. Valuation means almost nothing. What I've seen in the last week is several bouts of just sheer panic. and selling by all sorts of mechanisms. And under those circumstances, fundamentals and value don't matter. So the fact that you might own a good stock and you could argue a very good case for that stock means absolutely nothing. That stock could drop 20% in value without any issue at all. This is purely about emotion. It's about leverage, of which there is substantial amounts in the market. In some of the futures markets, we're looking at leverage of 25 times. That means that for those sort of players, they only need the underlying asset to fall by 4% and their equity is gone. So that gives you an idea of their need to respond to very small movements in the market, otherwise they get wiped out. And of course, we've got computer algorithms that are programmed to do all sorts of weird and wonderful things. So all of these factors are at play, and we certainly saw them in the market last week. You know, you don't get a 1,600 point range in the Dow Jones in a single night without some abnormal circumstances being applicable. Now, what I do, which members of Portfolio Analyst, of course, and my other services would know very well, is that I look for signs of what the big players are doing. Because if you can follow the big players, then you're generally in pretty good territory. And look, just stay with the basics. Don't get fancy. It's really just about buying high quality stocks when they've been oversold. It's a pretty simple formula. It's not easy to do because your emotions are engaged, but it isn't a whole lot more difficult than that. Now, the backdrop we've got at the moment, the US economy is accelerating. There's no question about that. And in fact, the cause of this correction was really the fact that we had a whole bunch of good news come through. And that got people a bit worried about inflation. Corporate profits are growing strongly in America. And they're doing okay around the rest of the world as well. Really importantly, in the US, the outlook statements through this earnings season have been more positive than normal. And there's a game that's played in America and has been for decades, and that is that the CEOs will lowball their next quarter estimates, and then the company beats them and everybody gets excited about that outcome and the share price goes up. But this time, the CEOs are starting to feel so confident about the outlook that they're actually ratcheting up their estimates. So that's another real positive. Then, of course, we've got tax reform and infrastructure spending, which is going to be a further boost, and I don't believe that it's fully priced in yet. So we've got that really yet to come. We've got Europe and Japan are improving, and we've got China doing a very sound job of managing their transition from a manufacturing export economy to a consumer-led economy. So when you look around the world, there are just so many positives, so many good trends that I just can't see any reason why the underlying trends are not going to continue. There might be some short-term upheaval because of stresses caused by derivatives exposure or various other panic situations, but that will just be temporary in my view. Now, stock prices advanced unsustainably, as I spoke about last week and also the week before. So no real surprise there. So we ended up with a parabolic increase through January. We ended up with a climactic stopping action, and that means now that we've got a change of character in the market. The market had been trending up in a very low volatility fashion. It shot up to the upside in a parabolic fashion at the end, and now that is it in terms of the uptrend for a bit of time. I think that a bit of time is at least 3 months. So I think the chances of a new high in the next 3 months are about zero. But I fully expect by the end of the year, and probably by maybe sometime early in the second half, that we're going to be at new highs. And we could even be over 3,000 points on the S&P. So I remain very bullish. It's just in the short term, the market is very volatile, and I really can't tell you what it's going to do. Now, bond yields will continue to work higher, and that's really what the market is now a bit fearful of and starting to reprice things on the basis that bond yields are going to be higher. But we're still a long way short of where it becomes a problem for stock valuations. The 10-year bond on the US Treasuries is about 2.85 at the moment. Anything over 3 is starting to get interesting, but really to be a problem for stock valuations, you've got to be somewhere between 4 and 5%. We're a long way short of that yet. So I don't buy into that particular issue at the moment. And in any case, some stocks, the better stocks, the stronger trends will always do far better than the index anyway. And even in a substantial bear market, which we've got virtually no chance of being in, some stocks even go up. Even during the 2008 debacle, there were some stocks that actually went up during that period. So the objective is to identify those stocks, and that's where the preparation comes in, because those stocks will start to move well before the index does. Panic selling produces bargains, and that's what we want to position ourselves to do. We've had a fair bit of panic already, but it's only been 1 week. I wouldn't be at all surprised to see a bit of a rally and then a bit more of a pullback. So how do we prepare for these things? We need to understand the major drivers of sector performance, and I talk about this nearly every week in one form or another. In the America market at the moment, the strongest sectors that are driven by fundamentals that are unlikely to change for the next couple of years. That's US banking because of higher interest rates. That's American housing because of supply and demand. It's industrials because of all the stimulus, the tax cuts, the improving economy, the infrastructure spending. And of course, technology is the cornerstone of just about everything that's going on at the moment. So they're the major sectors that are going to do extremely well no matter what. Of course, on top of that, China, which is just about my favourite sector of all. And commodity prices, they're going to be volatile, but they should tend to head upwards. But commodities aren't for everybody because they're just a bit too volatile for some. So just be a bit careful in that commodity space. The second thing you must do once you've understood where the major drivers are is to establish the best stocks for your purpose in each group. And before you can do that, you really need to understand, are you a momentum trader? So are you following the trends and you're not too worried about the fundamentals? Or are you more of a fundamentals trader that also has an eye on the charts as well? And either is fine, but you just need to be very clear about who you are. And different stocks fit different purposes. There are stocks that are not necessarily all that great on fundamentals, but gee, they've got a terrific momentum behind them. And if you buy a dip in a very strong momentum, then you've got a chance of making some money in the short term. We need to identify the strongest uptrends, and then we look for accumulation zones if it's at the end of a significant decline. Or if it's just a pause within an existing uptrend, then it's what we call a reaccumulation zone. And so there's opportunities within those 3 different forms of chart pattern. Really importantly to prepare early. You need to know what your entry setup looks like, because if you wait until the market has a sell-off, and ultimately some of the best opportunities occur when the market has an absolute capitulation washout. This is the night where everyone throws in the towel, the volumes go up, the selling is just enormous, and no one wants to know about being in the share market. That's the day that you want to start buying, or the day after. But if you wait until that occurs, it's then actually very difficult to make decisions about buying. You need to know what you want to buy in advance and roughly what that entry setup looks like. Really importantly to have a large suite of opportunities so that you can buy on your terms. If you've only got 5 or 10 stocks that you're watching, then you might be tempted to buy those stocks when it's not necessarily a good time, because you just sort of have this feeling that you want to get back in again. If you've got 50 or 100 stocks, you're in a much better position. Personally, I've got probably more like 500 stocks. that I'm watching. And so therefore I can afford to be extremely selective and only buy on my terms. And the result or the benefit of that to your overall result is substantial. This can't be done without a plan. I'm on about this all the time, have been for more than a decade, and it's a bit of a frustration of mine that most people seem to want to drag their feet on getting a plan. The natural inclination is to wait and see what happens. I don't know, to wait for some sort of sign from up above. But that's not a plan, doesn't work, and there's just no substitute for early and detailed preparation of what you're going to do. And that's what I strive to do throughout my services to those various members. The results are highly rewarding if you can do it that way, if you get yourself organized, and you can make significant profits in seemingly very short periods of time. So let's jump in. So those thoughts, I just can't give you any better advice than those perspectives. They took me a long time to understand those realities of the market. A lot of it was overcoming my own deficiencies as a trader, and I don't think I can give you any better advice than that summary there. Now the S&P fell by 4% across the week. It was the biggest fall in 18 months. So it wasn't, when you see the chart, it's not really all that dramatic, but it just feels dramatic because we've not seen anything like it for some time. We've become conditioned to the market just grinding higher and hardly ever going down. But on Friday night, we had a very nice reversal off the 200-day moving average. So I'm fully expecting that next week is actually probably going to be a fairly positive rebound. I can't tell you that we've seen the lows. We may go down and retest the lows. In fact, I think that's probably likely. We may even go down lower. I just don't know at this stage, but I am going to present you with a couple of scenarios. And as I said right at the start, putting aside the short term, which I can't tell you what the short term is going to do, and I'm not even going to try and predict it because that's just stupid. My approach is to be reactive to what the market does. I know how to read the market and I know how to respond to those signals, and that's all I'm doing. I'm just sitting back and responding to what the market is telling me about what the big players are doing. But this is close to an ideal big picture setup. All the fundamentals are terrific. Forget the argument about the fact that stocks are overvalued. They're a little bit overvalued, but the people that want to tell you that they're a long way overvalued are just using statistics that back their case. It's not really the situation at all. So I think this is a great ideal big picture perspective. We're now going to get a chance to buy great stocks at significantly lower prices than what we've been able to buy them for quite a few months. So I'm excited by this opportunity. Now the US dollar also has been very weak, but it turned up from oversold. No surprises there. It's managed to climb back above some key support levels. But I have not a lot of confidence about where the currencies are going in the short term. Okay, let's jump in and take a look at the American market. So I want to start first of all with the S&P on a monthly chart. So over here, these are the 2009 lows, and you can see that we're only a week and a bit in, but you can see it's been an ugly month, and we haven't had a month like that since 2008, and we're only partly into the month. The range is quite similar to what we saw in August of 2015. But the other thing I want to note from this chart is that the decent corrections that we had in 2011, we were down for 5 months. And then in 2015, we were down for 6 months in total. It was a little bit up and down, but in total, the market retraced over a period of 6 months. So we're only a week and a half into the start of this. So therefore, I think it's illogical to assume that this is just going to turn straight back up. Now, I believe in the next week, it could be positive. So let's look at where we are in the very short term. So we've sold down. We're now back to the 200-day moving average. We got a nice reversal off that on Friday night. And the 200-day moving average is a key technical level that people respond to. And so therefore it does have an impact on the market. Now we've had a sharp sell-off. I think the most likely scenario is that we perhaps get a bounce. Now whether the bounce is to here and then it goes sideways for a while or maybe sets a lower low, or whether it bounces up to here and then we get a more volatile scenario where we maybe head down, do a retest, maybe even go a bit lower, form a lower low. I don't know at this stage. I don't have enough information, but I think I'll have a good fix on it by the end of next week and certainly the week after that. So I think for sure that we are in some sort of consolidation period. Now, is that consolidation going to look like that? Or is that consolidation going to look like this and go on for a longer period of time? I just don't know at this point in time. But I just know that if we buy the sell-offs, so I would expect that if we do get a rise, that it'll be relatively short term, a week, maybe 2 weeks at the most, and then we'll be down again. So you don't want to, you either want to buy now, and I think that's a big call, or you certainly don't want to buy up here when people are starting to proclaim that the market correction is finished, because I think you're going to get whacked again on the other side, a little bit like a cyclone. It's going to come at you from the other direction. So I would be waiting for more information about where this market is going. Let's look at the NASDAQ. Excuse that noise. There's just an Army helicopter going overhead. So this is the QQQ, the ETF on the NASDAQ, and you can see that it hasn't pulled back quite to the 200-day moving average. We did get a nice reversal on Friday night, but my feeling is a bit of short-term, very short-term strength, then some more weakness, and then we'll take it from there. See what the market has to say. Let's look at the Russell. The Russell has managed to get down now below the 200-day moving average, a little bit underneath it, so it's a little bit weaker, but it has been now for quite a few months. But really nothing terribly untoward. We've had a bit of a decline in the advance decline line. There's less stocks trading above their 50-day and 200-day moving averages than there were a week and a half ago. But we're still in reasonable shape in that regard. Let me look at the VIX index, because this is where the action has been, and this has been caused by some extreme derivatives exposure and all the other associated computer algorithms that have fed off that. So let's just take a big picture look at the VIX. So the real extremes occurred in 2008, and then we had spikes in 2010, 2011, and then 2015-16. But you can see since then, since early 2016, we only just had a couple of blips and then virtually nothing. Look at this long period through here where the VIX was below about 12. Now we've shot up to, in fact, this is the VXO, but if you look at the actual VIX index itself, we've shot up to 50 during the week. And then we've had a couple of very volatile days. So the VIX still very, very nervous and may not be finished with the excursions to the upside yet. This is the US dollar. So we have managed to regain above this key support level, but I'm quite neutral on where this goes from here. I think if markets settle down, we'll probably see the US dollar come off the boil again a bit. Now that's translated to the Australian dollar, spiking up to 81 and then plummeting down to below 78, finished just on 78 for this week. So a lot of volatility in the currencies. Turning now to Australian stocks, the Aussie dollar fell to 78, and the ASX 200 lost a very large 283 points for the week, nearly 5%. And there was just nowhere to hide. A lot of the stocks that had been the strongest in the market experienced some fairly heavy profit taking. We saw a number of days where some of the high-flying stocks that are basically extremely good businesses, but they suffered 5, 6, 7, 8, 10% declines per session. So a lot of very heavy profit taking. So let's just jump in and take a look at the ASX. So we've managed to hold above the 6,000 point level for some time from before Christmas, but you can see in 2 sessions, which was basically Monday and Tuesday last week, our market just got absolutely smashed. And with what's going on overseas, I just can't see a catalyst to get our market back above 6,000 points. I just don't believe it's going to happen. While I'm here, let's look at precious metals. This is precious metals on a weekly basis. It was down, and this happens every time there's a panic. One of the most leveraged of the futures markets is the gold market. Generally, those futures players are leveraged by about 25 times, and so they're going to react very, very quickly. And what always happens is that you tend to get selling in the gold market in a panic, even though that might seem counterintuitive because gold is perceived as a safe haven. The reason is that people are basically having to liquidate in the gold market to cover losses elsewhere. So we did see some selling in the gold market. Nothing dramatic, but we're still basically in a sideways pattern. And if we look at GDX, it's lost this upward momentum of this triangle, and we're still basically in this wedge pattern. So really nothing doing in precious metals. So we were down by $18, and despite the fact that the US dollar had been favorable for some time, gold is still struggling to get any sort of momentum. So precious metal stocks, I believe you should stay away from them unless they're the highest quality producers, they're long-term holds, or there are in Australia a few local speculative developers that have got a good story. But we've just been through a period where a lot of very low quality stocks were being punted up from just a cent or two up to something a lot higher, but all those prices have come back fairly substantially now. So just be very careful in these speculative commodity markets. Copper declined. That was with the US dollar back to 306, and crude oil was down sharply. So it dipped from 66, 67 just a week and a bit ago. We're down under 60 again. Stocks got absolutely crushed, and they tended to lead the way down by a couple of days in the crude oil price. But then they reached some stability on Friday night, so that's a bit more of an encouraging sign. So there's the copper chart with the sell-off, and there's the very dramatic sell-off in crude oil. So to wrap it up, I don't have enough information yet on where the lows are. I don't predict the market. I read them and I respond to them. There's a very substantial difference between those two processes, and I just don't have enough information at this stage. I think there's a very high likelihood that this correction is not, even if we do get a bounce this week, that this correction is not done with. I think we'll retest the lows because that's what human psychology almost demands. And we could even form lower lows yet. But make no mistake, this is a great period. This is a period of terrific opportunity. So please don't be put off by it. Don't let the media get you. And just a reminder that the best stocks are going to turn far sooner than the index. For those of you that have been in any of my services, particularly portfolio analyst, where I spend a lot of time on education, on reading chart patterns, you will know that understanding the footprint of the big players is relatively straightforward to identify, and I think the opportunities are going to be very substantial. Now, portfolio analyst this week, I'm going to be looking at when and where the opportunities are. And if you're not in portfolio analyst, I'd really encourage you. There's a 2-week free trial, and then beyond that, if you chose to stay plugged in, I'm going to be able to provide you on the time to get back into the market when it's safe, when the opportunities are good, basically what to buy, how to take profit. I think it's going to be an invaluable period to be plugged into a service like Portfolio Analyst. There's my contact details for those that haven't been in communication with me before, and I'm sure we'll have another fascinating week. I'm sure probably a very volatile week, and we'll see how it all unfolds. That's it for this week. Cheers.